Hello and welcome to Mountain West IRA's Continuing Education. We're so happy to have Rosch Wadera from Upside Avenue with us today. Let me go ahead and get us out here. We did start off with, of course, a few technical difficulties today, but we are very, very happy that you were able to join us. Let me go ahead and make sure everybody's hooked up here. And we're looking pretty good. Okay. So let's see. Before we get started, and while we're waiting for others to join and get back in, yes, Karen, thank you. Okay, so before we get started, and while we're waiting for others to join us, let's get the housekeeping out of the way. First, I want to make sure everyone can hear us across all the platforms. Please comment if you can hear us okay. Okay, Facebook is good. Let me check on YouTube. Hi. Yes, I know we're a little late. We had a couple technical difficulties, but we're all doing good now. YouTube is good. Okay, Zoom. All right. All right, thank you. Wow, New York. This is not your lunch hour. Okay. All right, we are good to go. So first of all, just the reminder, Mountain West IRA doesn't offer investment, tax, financial, or legal advice to clients or endorse any investments. Individuals who believe that they need that kind of advice should consult with a licensed professional, of course. What we do though, we offer education. We want to connect you to experts in their fields like Rosch so that you can make informed decisions and invest in what you know and love, because after all, that's what it's all about, right? So, Rosch, thank you for joining us today. Folks, Rosch is the Director of Investor Relations for Upside Avenue, and he's responsible for financial reporting, SEC compliance, and capital raising while serving as a steward to the REIT's shareholders. He has almost a decade of experience across investment banking and real estate development, and Rosch provides a wide range of expertise in financial modeling, portfolio management, and investor relations. His previous experience includes prefabricated building projects for government agencies, like the City of Austin. He's also leading an investment syndicate, leading an investment syndication focused on single-family residential properties and publicly traded REITs, as well as investment banking transactions in the oil and gas industry. So, wow, you have really been just kind of all over the map and pretty deep into what you do, Rosch.
I suppose, yeah. A lot of words sounds like a lot, but making me sound way more experienced than I really am. Just on the same journey as everyone else.
There you go. It's always good when you really like what you do. So
Yeah.
I will go ahead and turn this over to you so that you can share with our folks. Now, a little later, because we do have a few platforms going here, we'll open it up for questions. And at that time, I will go ahead and share your questions with Rosch. Okay?
Okay.
Thank you.
And Diana, are we running until 2 p.m.?
We're running until you're done. So
okay.
We usually run about an hour.
Okay. Okay. So let me also, I guess, start off with also just another disclaimer in that, no securities are being offered for sale. Nothing is for sale here. It is just purely educational, just discussing kind of how me personally and we, the folks that I work with, how we look at investments to share, what we've learned and our process with other investors out there.
Awesome. So, it's that fine print that we always have to go through.
Yes. Yes. So I'd like to make it conversational. And I'm assuming, that I'm teaching this to like a middle schooler, like my nephew in middle school, kind of explaining to him how exactly wealth is created through real estate and really any investments, and more importantly, how to measure the rate at which it's accumulating and being created, so that we can make the wisest investment decisions. But would like to start off with just a question, which is just for the audience. I don't know, Diane, if they can answer vocally or if it's through chat. But how does how do y'all define the cap rate, the capitalization rate?
Okay, let's take a look and see what we've got here. Somebody just typed crickets.
Okay.
Okay, crickets. Okay, let me check YouTube. Nope, YouTube's not talking now. Zoom. Capitalization rate is the money I want to make.
Yep.
Okay.
I agree with that.
Anybody else? No, I agree with the others. Crickets.
Okay. So there's like an academic definition, which can be just reduced just to a formula. But then there's also kind of how I explain it, how I think about it conceptually, and what I believe it to mean, and the reason is probably one of the most important metrics what we'll look at. I think ultimately almost every real estate investment, much of it just comes down to this one metric. So what is this metric? It is, in a formula sense, it's the total cash that I put in to acquire an asset. So you add up all the expenses that you faced, all the cash that physically went out the door, or if you're buying the asset using some other store of value like stock or even some crazy things now, some crypto and whatnot. But it's just that total value is the denominator. So out of that cash that I put into the asset to acquire the asset, how much cash flow is it producing for me? And most times we just always talk about things on an annual basis, but you can say this is my cash flow on a monthly basis, this is my cash flow every week. Whatever it is, it's just that periodic cash flow divided by how much cash you had put in to acquire that cash flow. So really, I feel that what generates the wealth is not just ownership of assets, but you take it a step even further, it's the cash flow that those assets produce. So we're trying to buy as much cash flow as we possibly can, and we would like to spend as little to get the most cash flow out of it. So capitalization rate, in my terminology, is just the rate at which I'm getting my money back. So for example, I have this spreadsheet here, just arbitrary numbers of a typical real estate asset. Whether it's office, whether it's multifamily, whether it's retail, whether it's industrial, real estate, the financial profile is fairly simple compared to more complex, operating companies like Amazon or Dell or Walmart. So here we have the lease revenue. So this is the asset that we purchased, and let's just say it's producing $17,000 a year, not in net cash flow, but in revenue. So that's how many dollars the asset brings in. That's how much we charge the tenants. That's how much the customer or the tenant pays for using our service, in this case, housing of some form or the other. There's always going to be a variety of expenses that take off of that. Key here is when you're looking at different real estate assets and when you model them out, even if you're not doing a complex spreadsheet, you don't need to. I'll show you a shortcut at the end. But you want to separate the expenses in terms of variable and fixed. So I've done that here, but we'll just jump straight to the point to answer the original question, the capitalization, so we all understand it on the same page. This asset in this scenario, based on the financials we're looking at, is producing $10,000 a year. So we can say annually we're getting back 10% of what we paid, which is assuming that we had spent $100,000 to acquire this asset. This is really good, in my opinion. To get a cash flow of 10% is phenomenal, actually. Without knowing anything else about the investment. But what it's saying is we're capitalizing at the rate of 10%. We're getting our money back at the rate of 10%. So over 10 years, getting back 10% in each year, in the 10th year, I've made all my money back. But no more than that. So that's just one conceptual, finance 101, first day in school. Everyone has to understand is that capitalization rate. If we can move to the next slide. Just I want to make sure that I iterate because all of this is just about preparing ourselves for the situation that we face every day where we have some cash to invest. Where do we invest it? Let's say we have 2 or 3 opportunities that we identified we're comfortable with. Now we just reduce it to the numbers to say that this is where our money should be allocated because it's getting a higher return rate. And of course, we'll also get into how do you factor in the risk in your return rate. But I just wanted to hit a few things, make sure that I didn't mention missing them, especially for the novices that I'm targeting to avoid certain mistakes that I and some other folks have made. Is just in your cash flow profile, if we're looking at acquiring an asset and we're ultimately projecting how much cash it's going to produce in the next 12 months based off of how much it did in the last 12 or 24 months. So we're using the past figures to say this is how much cash we're going to get in the future. And this is where your guess as to that cash flow, and the more you back it up with data, probably the better idea you have versus the other guy or gal as far as what this asset is worth. And therefore, you should be able to make superior capital allocation decisions. But I just wanted to make sure you compare apples to apples. So if I'm looking at the cash flow of one asset being 10,000 and another office space being 10,000, obviously it goes without saying, most of you probably would have already known, just make sure that if you're looking at the cash flow before taxes, your personal taxes, you compare all the other cash flows before your personal taxes. If one is telling you what the cash flow is after your taxes, make sure that when you evaluate it against all the other investment opportunities you're faced with, that you're also looking at it after taxes. So just keep it apples to apples, in other words.
Absolutely.
And so leverage, how does the use of debt enhance our returns? So maybe another question for the audience, and maybe we'll get more crickets, no problem. But curious if anyone wants to kind of share their thoughts in their words. How does the use of debt enhance my return on investment?
Okay, let's take a look. No debt. Debt is evil. Just kidding. I leverage. Sorry, was that houses? I leverage my houses to buy more houses. Well, that's a good way to do it. Let's check in over here. Oh boy. Okay. People are really happy about leverage.
Right.
I doubled my IRA using leverage in less than 4 years. Yeah, I've seen that happen before. Oh, hi, Cindy. Okay. Let's see. We've got leverage. Leverage is the way to go. You can go so much further if you leverage. You just have to be careful. Credit cards are bad. Okay, we're not talking about credit cards.
So I'm really liking these responses. Definitely a very well educated and a funny crowd too. But I noticed one of the first ones was, all debt is evil. Just kidding. But there is maybe some truth to that, and I guess in my mind, when we talk about debt, we should clarify what type of debt we're talking about. There is what I refer to as productive debt, and then there is consumptive debt. So debt that is used to consume resources, would be consumptive. So for me to go and buy a car, a TV,
Or yet another bigger TV.
yeah, exactly. It's there's no resale value, or rather, that resale value is less than what I had purchased it for, and there's not necessarily any cash flow. So I'm just borrowing from my future cash flows, from my future net worth, from my future self to pay for what I want right now. And
So borrowing money to make money.
well, in these cases, we're not making money. So that's why I'm saying with debt, we'll clarify it too: consumptive versus productive. So that's the boring stuff. Let's talk about how we can use that debt to make ourselves money.
Cool.
And that is what I would refer to as productive debt. So, like if I owned a factory and I borrowed 50 million to upgrade the factory, to automate it, maybe not. I'd like to keep some jobs, but also to add some new equipment so I can produce more widgets. Then in that case, I have lowered my cash flow because now I have this interest expense. So my cash flow is lower than what I previously had before I took on this debt, but actually it's going to be higher because now I'm producing more in revenue. So not immediately, but hopefully in the near term, I'll start to see that cash flow profile increase because the additional capital that I borrowed, it's productive debt. I'm using it to produce more. So if we look at this spreadsheet together, again, now the same cash flow profile we had last time, same asset. This time, instead of paying 100 grand, we only paid 50 grand cash out of pocket, and we borrowed the rest. We went to productivedebtbank.com and they gave us a loan. They approved us. So now my cash flow is lower than in the last scenario. Like I said, we reduced the interest expense. So previously, if we looked at could we go back 2 slides, Diana?
Absolutely.
And let's look at that net operating income, that first bolded line, 10,000. Now, fast forward, because of the interest expense on the 50 grand that we borrowed, we go 2 slides ahead, and now we're only making 7,500. So how did my returns become enhanced if I just lowered my cash flow profile? And I'll say a quick and easy way just to do it in your head, to actually calculate, kind of one of the best optimal, how much debt should you borrow to acquire this asset? How much is too much? How much is too little? And how much is it juicing up my returns? You look at it this way. In the prior case, we had purchased the asset for 100 grand. Now we've lowered our cash out of pocket by 50%. So although our cash flow has reduced from 10,000 to 7,500, it's reduced by 25%. But the amount of cash that we put in is reduced by 50%. So long as we reduce the amount of cash that we put in by a higher proportion, then that interest expense is going to lower the amount of cash flow that we bring in. We're enhancing our returns.
Mm-hmm.
So you just kind of ask yourself 2 questions. Just if I can be a little bit repetitive, or if I may, is how much did my cash out of pocket decrease on a percentage basis? And with that loan expense, how much is my cash flow decreasing on a percentage basis? Naturally, I want to pay less. I want the cash out of pocket to decrease at a larger rate than that cash flow is. So that's kind of what I was just getting at over here in terms of how leverage enhances those returns. But naturally, it would be a shame if I didn't mention the risk that this puts on us that you don't necessarily see. So whereas previously my cash flow was 10 grand a year, say something happened and I had to replace the HVAC and there was an accident, maybe my insurance covered it, but even then I still have to pay the deductible. So it turns out my expenses are a lot more than I thought. because when I initially tried to project out what that cash flow would be, I was wrong. Something came up I didn't predict. Now I have 10,000, I have just enough to cover it, just random scenarios. But in this second scenario where I use leverage, I've lowered my cash flow profile to 7,500. So that means that I have that much less of a cushion to pay for the unexpected. So think about it. You can't look at debt in terms of how much it reduces your returns without also looking at the flip side of the equation is how much less cash now am I going to have available to cover the unexpected? And it can get very enticing. I've been in situations myself where the bank and my mortgage lender, great guy, will say you only need to put 5% down. You can put less down. I'll get you an even better loan. But a lot of times what happens once you start putting less down, it's funny how the bank treats it. So you'll notice with conventional home loans. I'm also a licensed agent, so I can't help but talk about buying a house. But once you drop down on your down payment from 20, I think when it goes below 20, I think, all of a sudden you're required to pay the mortgage insurance that the federal government requires once you pay for a smaller down payment. So then your monthly expenses now become even higher. So again, that cash flow profile is reduced if this were a single family rental, for example. So I think I've beaten that point to death. But I'll do want to, before going on the next slide, just leave y'all with a funny quote. Yeah, this is great. When I was in banking, I think one of the managing directors, he would joke that my goal in life is to take on as much debt, acquire in as much assets as I can, and then to die, leaving as much debt unpaid as possible. So it's a very morbid joke, but a lot of folks go, yeah, a lot of folks go down that path where, we forget it's not just acquiring as much in assets as possible, because the bank will loan you money to keep buying more and more in assets because you're their cash flow. Your interest expense is their profit. So they're happy to do so. But it's also the cash flow that you're acquiring. And, that spread between how much cash am I bringing in? What's my interest expense? We want to leave a healthy cushion between the two.
Right.
So, just going back one slide. And if anyone has any questions, Diana, interject me at any time. But I did want to clarify just 2 points, not to reminisce. On that leverage profile that we were looking at, the cash flow, the spreadsheet, you notice I had interest expense. Yeah, I'm referring specifically to like interest expense, so not the principal payment. So if you're getting a bank loan to acquire a real estate asset, which I think 99% of the people buying real estate are using a loan, then you got to separate the mortgage payment between the interest expense and the principal. So the interest expense is your actual cost. That is money out the door. You're not getting anything back for that. That's your expense. That's why we call it interest expense. But your principal, as I'm sure everyone knows, most likely y'all have bought a home. So that principal just goes straight equity to you. So that's literally just trading dollars for brick. And that's a good thing because that brick will keep up with inflation, whereas those dollars will diminish over time. Caveat though is it's stuck in the house, so it's not actual cash flow to you. You're making money, but you don't get that cash flow to you, which depends on what you're investing for, income or growth. But other consideration people don't realize is if I'm not getting that actual cash flow to me, I'm not able to reinvest it. And I'll save that for when we get to the compounding slide. So
right. We do have one comment over here from YouTube. It's very important to me to know what the cost of the money is. It's okay to take out a loan, but if the interest rate is too high, sometimes it just makes no sense.
Absolutely. 100% agree. And my quick and easy, one of the first questions I'll always ask or look for in the financials from any possible investment is what's that cap rate? So that's the rate of which we're getting our money back. Say it's 10%, and compare that to the interest rate on the debt, which is what your very wise YouTube commenter is alluding to. Is if our cap rate is 10% and our interest rate is 12%, it's supposed to be.
Yeah, that doesn't work.
Yeah, exactly, right? So you don't need an MBA or a finance degree to say, hey, wait a minute, one number is supposed to be higher than the other. And the higher the cap rate is, the greater that spread, the better. I think mortgage rates are around 3% right now. So
Yeah, they did just go up here again. Just a couple days ago, right?
yeah, and I'd be curious at the end, kind of what your viewers think as far as where those interest rates are going to go and how that affects their investments. But I do want to.
Apparently, everyone on YouTube thinks it's going up because I see up, 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 up,
Yeah,
sideways. No, we're not going side up, up. Yeah.
it's got to go up, in my opinion. I think everyone sees like, look, if we're going to be in a hyperinflationary environment, it's got to go up. But there is another interest the Federal Reserve, I believe, has to consider, which is all of the debt that the federal government owns. The more inflation there is, that debt erodes in value. So inflation, in a way, actually helps the borrower by lowering the debt value in comparison to, in this case, the tax revenue that the federal government would get. But I think
unlike the federal government, we just can't print more money. So
yeah,
we have to be a little more careful with ours.
in any case, it's not in our control what the Fed does, right? So
right.
Let's look at another slide here. Yeah, so we talked about that. The insurance deductible, before we move on to the next slide, is just a quick point. Especially, I think most folks start out with a rental property. At least that's how I started out when it comes to real estate. And when it comes to us retail investors, I'm speaking about myself on behalf of retail investors, just defined as, we might have enough money for one or two properties, but we're not just buying office complexes, not just yet. But my point on that was just when you underwrite yourself, because you're the underwriter, you're the investor, possibly buying that next asset, make sure you don't forget the insurance deductible. So your insurance will cover, if a hurricane tears a roof off, but they're going to charge you that deductible. So that cash flow profile keeps some working capital, some cash in the bank to cover that, or at least be prepared in the event that occurs. You have some other source to pull that cash from. If we may continue. Yeah.
Ready for the next one?
Yes. Thank you. So we'll actually kind of skip through this one pretty quick. Naturally, we're not going to wait. At a cap rate of 10%, it takes 10 years for us to get our money back. We don't have to wait 10 years. We can sell it early. So this is just, I'm getting more towards the multifamily investors, which are basically, you guys think about fix and flip for the residential side. Multifamily investors are pretty much doing the same thing. We just like to use a fancier term, opportunistic rehabilitation opportunities, but we're just fixing it. So I love the terminology in finance, because we're not really doing anything that requires more than basic arithmetic, but we use terms that make it sound real fun. But
right.
Yeah. So just on the multifamily side, what I'm getting to it in this slide is that we can enter at a certain cap rate, 10%. Let's assume we exit and sell the asset, at that same cap rate. But if we can change the cash profile while we hold it, so if you find an opportunity to buy something at a decent cap rate, first and foremost. In fact, there have been studies, and if you do financial modeling, probably, we'll weigh all the factors, how much importance they have on our return on our investment. So for example, the purchase price, the rate of growth of the cash flow, the rate on the interest. There's only a handful of variables that you can reduce all the investments to and understand exactly how important they are to your total return. And by far, the most important variable in that equation that determines your total return is the purchase price. If you get it cheap enough, you're already setting yourself up well to get a high return on investment. And then in addition to that, if you're able to change the cash flow profile, meaning you can increase the net cash flow, whether it's through reducing the expenses or increasing the rents, then your asset is now a lot more valuable. It's producing cash to you at a much faster rate than it was when you bought it. So you've added value. That's where the term value add comes from. So that's what we'll move on to the next slide. And
Okay. And yes, we've had a few questions. Some people
okay.
came in late, and they're asking if there's a way that they can access this later. Yes, we will have a replay available. It'll be available on both Facebook and our YouTube channel. So if any of you came in late or missed us because we had the little hitch in our get along right there at the very beginning, yes, there will be a replay. Okay.
Yep. And anyone can reach out to me. I think my contact info is at the end. If you want a copy of this slide, if you want a template model that I use, I'm happy to share. Yeah, so there were some other key points that I just wanted to touch on. And I know part of what I'm saying is a little bit out of place, but I just don't want to miss any of these points and touch on each one of them. But it'll all come together in the end. Cost of leasing. So all I'm trying to get at here is the asset that you own. We're talking about real estate specifically. And again, it doesn't matter if it's multifamily, if it's office, retail, the business model is the same. You charge rent, you collect rent. And then there's a additional element that we just touched on where you can rehab, renovate to improve cash flow, but leasing it out. Think about if you are leasing it out yourself, which by the way, if you own the asset, you have an ownership interest over, I believe, 10%, then technically you're have a significant stake. You can lease it out yourself directly. You're not required by any law to use a realtor or a broker or a licensed agent, but I think 9 out of 10 times you're going to want to use a broker or licensed agent. All I'm getting at here is just think about how you incentivize the agent or that broker to lease out your property, whether you want to pay them on a one-time commission, like the first month's rent, or if you want to pay them a percent of rent. So every month you collect X and they get a small cut. If you do it on a recurring basis where they get a percent of the cash flow, they may start to be incentivized to get you on a longer term lease, 12, 24, 36 months. 24 month is not uncommon in residential. For those that are looking at rental properties, I don't know why folks don't look more towards 12-month leases. It does lock in a rate. You may miss out on possibly raising rents, but you don't have that vacancy after the first year. So you eliminate your number of vacancies. When you have a vacancy, I know I'm saying what's blatantly obvious, but you've got expenses, but you don't have revenue to pay those expenses. So think about how you incentivize the agent. Think for yourself, what is it that you prefer, a longer term lease or a higher rate, but at a shorter term, and then have to go through the releasing process and the expenses that creates. I was just speaking with a gentleman this morning. He has a bunch of Airbnb properties, and always assumed foolishly that getting a 12, 24-month lease on a residential property is always superior to doing Airbnb because of all the vacancies and the clean out that he has to go through and the releasing. But he's Airbnb them out at such a high rate that it actually looked pretty compelling. I had to reconsider how I was leasing out my properties. So you just always trading off more fixed of a guarantee, but at a lower rate versus I'm getting paid more money, but I don't have much of a fixed guarantee going too far out into the future. And then who pays utilities in real estate? I think it's common. The more you can shift those costs off to your tenants, like the utilities, for example, the Wi-Fi, all this and that, the better, naturally. That also keeps them mindful of how much they use the utilities and whatnot. But yeah, we'll move on to the next slide. How am I doing, Diana?
Real good. We're pretty good on time here. We got about 20 minutes left.
Okay, great. Yeah, just don't fall asleep on me. So, compounding. Okay, these are not my words. I'm directly quoting Albert Einstein when I say compounding is the eighth wonder of the world. So, if one of the most intelligent men or women that we look at historically is referring to compounding as the eighth wonder of the world, clearly this is some type of force that those who know it, it's like the hidden secret of wealth, but it's not really hidden and it's not a secret. Um, what are we talking about here? Is basically how do you invest a dollar and it gives you this cash flow. So my dollar is capitalizing itself, paying me out a certain. We can refer to it as a dividend, a distribution. Never mind the terminology. Just understand it's the money that's back in our pocket after all expenses. Um, if you reinvest that, then in the following month or quarter or year, whatever, in the following period, my net cash flow to me should be more than it was in the prior period. And if we keep redoing this cycle over every month, every quarter, every year, um, it's the rate at which your cash flow grows is not linear, it's exponential. So if y'all remember from y'all's high school algebra 2 class when we were graphing, linear graphs were where uh, as you go to the right, it increases as the same rate on the y-axis. But exponential was one where as you go to the right, the y-axis starts to increase at a much faster rate over time. Um, so I just want to hone it in again and see if there are any comments. But if I had to explain it to my nephew in sixth grade, I would tell him every dollar we put away today is giving us 10 cents every month. And I then again put away those 10 cents. So I defer consumption today to increase my purchasing power tomorrow. I probably wouldn't word it that way to him, but my point is, in the next month, I now have $1.10 working for me, and that now has produced 11 cents, and I'll reinvest it. So now in the third month, I have $1.21 working for me, again paying out 10%. So obviously, I'm a big fan of Warren Buffett. I think anyone that gets into investing, his name always comes up. And if I looked at the Berkshire Hathaway, the annual reports that he had going back, this guy's been around for like 100 years. It's crazy. So, and one of the first investments he made from his original partnership was Geico. So that he could take advantage of this compounding effect. So Geico was a nascent insurer at that time, not what it is today. And we all know how insurance companies work, similar to banks. Basically, all of finance is people are paying. So folks are paying Geico every month. So Geico gets money every month, and they don't have much of expenses. So they reinvest a lot of that cash flow. Of course, they're underwriters and risk analysts are making sure that they have enough cash on hand to cover any disasters or whatever they're insuring. But they're collecting your cash flow, your expense every month that they charge you, and they pay it out in dividends. So Warren Buffett bought Geico so that he could get access to these dividends. So he's first looking at stocks where they had a good dividend yield, and he saw that the overall stock price would still continue to increase at the same time. And he took those dividends and he just kept reinvesting them. And now he's at a point where his dividend yield alone every quarter is in the billions, which is insane. It's insane for me to fathom that someone is collecting that much in dividends alone. But it was through the reinvestment of those dividends. So everyone's always thinking, how much money am I putting in? How much money am I getting out at the end? And there's nothing wrong with that. But if you're getting cash flow at the same time in the interim, and you're constantly reinvesting that cash flow, don't ignore that, because you're ignoring a big piece of the wealth accumulation process.
Oh, definitely. If you roll that snowball down the hill, it can get pretty huge. But if you keep taking chunks out of it, it won't be quite as impressive when it gets to the bottom of the hill.
Absolutely, absolutely. And Geico was one financial instrument. It's stock that Buffett used. Wells Fargo was another. Banks are big on dividend player payouts. So, and I also missed one other point on that prior liquidation slide. Just remember, when you liquidate an asset, because we're all talking about asset accumulation over here, so we're assuming that everything you have is being reinvested. You can get a high return on investment, and they're telling you, hey, it's a 2 or 3 year play max. That's great, but when I liquidate, do you pay taxes on it? Do you pay broker fees? And then now you have that cash that you liquidated, idle money. You then do have to spend time to reinvest it again, right? So when you compare one long-term investment that might be telling you a little bit of a lower return rate versus a short-term investment that's giving you a higher rate, make sure, again, apples to apples on the short term. Are you factoring the cost of tax every time you exit and the time it takes to then reinvest? You might find that those long-term investments at a slightly lower rate might actually be more advantageous.
Makes sense. Ready for the next one?
Yes, ma'am. So, okay, this is, again, I'm always looking for the shorthand cuts because right out of college, I did investment banking, as an analyst, and it was just spent so much time in Excel and almost went crazy just with all the numbers, constantly, modeling them out. But kept, trying to understand from a 10,000 foot level, what's the overall concept that's going into these models? What are the underlying variables? And if we can just identify those variables, we could do these calculations in our head. We shouldn't have to make it too complicated if we understand what those variables are. So one quick and dirty, shorthand trick that I use is maintenance versus growth expenditures. So now I'm talking more about the multifamily investments where the operator, the sponsor is asking you to invest with he or she and saying that the cash flow or the cap rate on this asset is 10%. But I can increase the cash flow from, say, 10,000 a year to 12,000 a year. And another operator is saying I can increase the cash flow from 10,000 a year to 15,000 a year. So naturally, going from 10 to 15 sounds a lot more attractive. But the more I start to stretch how much I can change the cash flow, the more, not necessarily suspicious, but diligent you have to become. So in any asset, ask yourself, how much cash flow is coming from the asset as it is? How much additional cash flow can be created after I renovate it? And ask yourself, how much does that renovation cost? So if it costs, I don't know, 10,000 to produce an additional 1,000 of cash flow. So remember, we're just reducing everything to how much cash flow am I buying. I'm increasing the cash flow at a rate of, or my follow-on investment rather, to renovate, is giving me a 10% yield. That's really good. So it just, ask yourself, is more of the money coming from the renovation, or is more of the money just coming from purchasing as it is and the existing cash flow before I even change anything? Naturally, if more of the money is dependent upon the renovation, you're taking on more risk because you have no guarantee that those renovations will pan out in the way that you had hoped. And I'm surprised with how many sophisticated operators managing $250 million plus of assets spend money on renovations that don't get them a return rate high enough, whereas they should have just spent that money acquiring more assets or paying it out to the investors. But naturally your operator might have a little bit of a bias to want to spend more money to renovate than they actually should. So renovation is great, but naturally watch the risk. You know, is it reasonable, the expectations that they're giving you? The market rents, are they in line with what they're telling you they will be able to rent it out for? Is it significantly over? Let me just turn with another real life example, if I may. Is there was an asset that I was involved with where it was purchased. It was a complex in Texas, and the renovation that was deployed to improve the cash flow file failed. Failed in the sense that for as much as was spent to renovate the property, it did not increase the cash flow accordingly. And it's not that the renovations were done incorrectly. It was just the area that it's in. No matter how nice you made that asset, the folks in that area are not going to pay more than the option down the street. So just random things that come to mind that I want to share. We can move on to the next slide.
Okay, and I do actually have a question for you here. It's from Gavin.
Yes.
He says, do you have an Excel sheet that you use for analyzing potential real estate deals? Thanks, Gavin.
So absolutely, yes. I never make an investment without opening up an Excel sheet. But I'm not saying that you have to create an Excel model before you invest. Also, to answer that question, yes, I have an Excel sheet, but it's not like a generic template that I use for each one. I'll literally take the numbers that I was given, just open up a blank spreadsheet, and just remember, start with my revenue is this much, the expenses are this much, this is the net cash flow. And divide that by how much it costs to acquire the asset. Just start there with everything, and that's like 75% of evaluating the investment is right there. That last 25% is where you get more detailed, which just depends on, to each their own.
Right. Let's see if we have one more here. Facebook's very active today. Where can one go to find opportunities to invest? Thank you, Lance. We can also put some more informational links at the end of this video. We'll put those in the comments on the different platforms. So stand by for that. But in the meantime, Rosch, where can they go to find opportunities to invest?
So I appreciate the question, but respectfully, I'll probably decline from answering just because I think in this presentation, I'm not actually allowed to sell or recommend any investments. So I'll just leave it at that.
Yep. We're always really big on the education, but when it comes to investing, it's what do you want to invest in? If you want to invest in real estate, it doesn't hurt to get out there and network. Meet with some of the local REITs in your area. Meet with some of the masterminds in your area. You can go out to meetup.com. They have many things that you can go take a look at where you can meet with people who are doing the things you want to do. Listen to them, but be sure you do your due diligence. There's a lot out there, and the trick is to really get yourself the education and the connections.
Yep. Okay, so now this is my slide where it sometimes gets contentious, even with the folks that I work with. But there's so many valuation methods. If you just Google how to value an asset, which you have to do if you're investing in any investment, you have to decipher for yourself what is the value of that investment. Put a number on it and compare it to what they're offering it to you. Is it a fair valuation? So now we get into valuation. So many different methods. I could use the income approach. I could use the rent multiplier. I could use the discounted cash flow. I could do a net present value, or I could just look at the cap rate or a sales comp, which isn't even really a valuation method, but I'll get into that in a minute. Or I could do the dividend discount model. So, oh my goodness, there's so many methods. What do I do? It's too complicated. Forget this. I'm just going to buy the index. No, don't be lazy. But also, so many different methods, it's all the same thing, all one underlying concept. And this is where some folks might disagree. But I'll present to you my argument. What does it all come down to? The cash flow. For example, if I use the income approach to value real estate, I'm basing it off the income, and I'm either discounting the present value of those future cash flows, or I'm putting a multiplier on those cash flows. But in either case, it's the cash flow that's determining the output. The rent multiplier, again, rent, we're just using the rent collected rather than the cash flow because we're just a little bit too lazy or don't have the time to get into the actual expenses and what the net cash flow is. But we know it's a function of the rent that it brings in. So we'll just use that as a proxy, put a multiple on it. Again, it comes from the cash flow. Discounted cash flow, in my opinion, is actually the only legitimate valuation because it takes the net cash flow and it discounts it to the present value, which is based on, your rate of return that you're expecting. So based on what rate of return you're expecting, the present value should be this much. If it's being sold to you or you're purchasing it at that price, you're going to get that rate of return. Not guaranteed, obviously, but it just all comes down to the cash flow. Cap rate, again, sales comps. Sales comps is just looking at what somebody else paid to buy a similar asset. It doesn't mean anything as far as that's what the asset is worth. So while everyone else is looking at what everyone else paid, which absolutely you want to take into consideration, you have a framework to tie it down to the cash flow. So you can kind of start judging for yourself. Is the market overvalued? Is the market undervalued? If stocks are selling at 20 times earnings, but I can buy this real estate for 10 times earnings, it gives you an idea to compare across asset classes where you should allocate your money to get the highest rate of return. I had some notes on this slide. Yes.
Hotel REITs case study.
Oh yeah, no, I'll save that for another time. I don't want to put everyone to sleep, but we can go to the next slide. This is my favorite part. I love this because I love telling people that you are someone else's asset that they're deriving income from. Which so if we, yeah, okay. Sometimes people ask, well, how do you value my house? It's not based on any. Oh, one slide previous. Yeah, so my house, how do you value my house? Because, it's based on sales comps. It has nothing to do with cash flow. So, okay, we're looking at in the neighborhood what everyone else is paying to buy this house. Well, how are they deciding how much to pay to buy those houses? So the other buyers are going to their lender who is saying, you qualify for this much. So I'm telling you, you qualify for this much. And that then determines essentially how much you can pay, how much you can bid to acquire that house down the street. And the lender is saying you qualify for this much based on what? He or she is looking at your income, your cash flow, and how much he could charge you in mortgage payments. So even home prices, ultimately the valuation is tied down to the cash flow. So if you look back in 06, 07, when the market was grossly overpriced and shortly collapsed afterwards, you could have looked at all of America and you could have looked at home prices. And there's an economist that tracks this, the Case-Shiller Index. He's looking at the home prices, but she also could have looked at the incomes of the Americans living in those homes. And if the home prices keep going up, but their incomes are not going up, that's when it collapsed. So people had a bunch of mortgage payments that they couldn't make. So that's why I say valuation always ties down to, in some form or the other, cash flow. Now you ask, oh, but how do I invest in startups that don't have any cash flow? Clearly there's a value. Yes, that value is based on the future cash flow that the venture capitalists believe that asset will produce. So Uber, no cash flow. Why would I buy shares of Uber? Because I'm seeing these folks running Uber just expanding all across the world. I'm seeing all the cars that are driving Uber, all the passengers. I use it. I know they have revenue, and I know eventually that's going to trickle down to cash flow. And this is what I think that cash flow is going to be in the future. Therefore, that's how much I'll pay for it now. So even startup valuations, but Sometimes people get angry when I tell them this. They say, oh, no, there's more to it than cash flow. Now I'm going to give you one more example to really drive this point in. Say you're looking at a growth stock. Let's talk about Google. Let's talk about Amazon. And you want to buy either of those stocks or even Tesla. What the tech companies in particular, the growth companies are doing, and the way I look at growth stocks, I don't know, I'm not going to tell anyone else how they should look at things, but what they're doing is, Google's a great example. They produce a lot in earnings, and rather than paying those earnings out to the investors, they're reinvesting it for you on your behalf to either acquire other companies in their related field that they know they can capitalize on and increase the cash flow, like YouTube or Android or whatever acquisitions they've done, or they'll spend that money internally to develop new products. Like I think they have this new phone plan that Google now is offering, so they're getting into that business. And so they have cash flow, but they're not going to pay it out to you in a dividend. They're going to take it to reinvest, to acquire other businesses, to start other businesses that then produce more cash flow for you in the long run. And the best investment, in my opinion, is one where I can buy it at a good yield to cash flow. That's one. But rather than the company or the syndicator paying out the cash flow to me, he's able to identify opportunities to reinvest that cash flow on my behalf. Now, the reason that makes it even better is because if they reinvest the cash flow for me, I don't pay taxes on it. If they pay it out in dividends to me, I get taxed. I have to pay taxes on those dividends. So I'd rather they keep reinvesting, like Amazon did. You know, the guy started with just books and started selling all kinds of other things. Now he's doing cloud services and who knows what else. So he kept finding ways to reinvest the earnings of Amazon to then create more cash flow down the line. Now, how do you compare two assets, two opportunities, where they both require the same amount of money in, so money out of your pocket to buy it? They'll both bring out the same money, but like as in pay out the same money to you, whether it's in cash flow or whether it's in the return of your principal. So the money in and the money out, the two variables are the same, but the timing is different. Can we ask the audience how they would pick one or the other?
With my mic unmuted. So say the question again, please. Oh, somebody didn't hear the whole thing.
Yep. No, it's my fault. If I offer you two investments, A versus B, A costs $100, you get back $110. B costs $100, and you get back $110. Now I'm going to make it a little more interesting. So I'm an even harder question than what I asked is B pays you back $110, but no cash flow in the time period, in let's just say a year. So I buy it for 100, I sell it for 110, real simple. That's option B. Option A, I buy it for 100. It pays me $5 in dividends in that same time period, and then I sell it at the end for 105. So in total, I've made $10 on both. But in option A, half of it came from the dividend, the other half came from the resale. In option B, all of it came from the resale. Which is better?
A.
Yes.
A
Yes.
is better.
Yes.
Let's see. Oh, Zoom got it too. A is better. I like B because I want my money, but A is better.
All right. Good.
Option A, yes.
Even the cynics had to admit option A is better. I'm making the same $10, but in one case, I get those $10 back, or I get the $5 earlier in the form of dividends. So we're not going to get into the tax. We want to compare apples to apples, but that $5 that I get, let's assume I've reinvested all of it. So that has grown as well. And then let's just say it grew to $5.50 by the end of that first year. So actually I've made $10.50. 50 cents more than the other. Just because it paid me dividends, I reinvested them. So great. We can move on to the next one.
Okay. And folks, I know we're going over a little bit. Don't worry. If you have to jump off, we will have a replay.
Yeah. So this is any investment, I believe, in my opinion, not accounting for the risk. One might be riskier than the other. Let's just put that aside for a second. If we're just looking at the numbers, I should be able to look at any investment and in my head tell you if one is better than the other based on 3 variables. So it's very simple. All the financial modeling that I did in investment banking, the discounted cash flows, the leverage buyouts analysis, the dividend discount models, they all always come down to 3 variables, which is, and this is what the IRR computes. It's factored by these 3 variables. Number 1 is how much money do I have to put in? Obviously, we want that to be as little as possible. The less, the better. How much money do I get back? We want that to be as much as possible. The more, the better. But the timing is where you have to make adjustments. So if I get less money back to me, that may sound less attractive, but if it's paid back to me in 5 years, whereas the other opportunity is 10 years, now that timing makes the less money more attractive just because it comes back earlier, and we're assuming I can reinvest that, right? So the simplest is cap rate, how much money we get divided by the purchase price. We want that to be as high as possible, but also consider the timing of when you sell and whatnot. Just 3 variables, never forget. And we'll end with just a few quotes that I wanted to share on the following slides. So I'm going to read it out loud, but to invest successfully over a lifetime does not require a stratospheric IQ. This is Warren Buffett. He's saying it doesn't require unusual business insights or inside information. What's needed is a sound intellectual framework for making decisions and the ability to keep emotions from corroding that framework. So what is your framework, and understand how your emotions are clouding or interacting with that framework. So our framework is to acquire as much cash flow for as little as possible. In other words, to get the highest yield. In other words, to get the highest cap rate. And we use that to make our decisions, but keep emotions from corroding that framework. So for example, if someone asked me, Rosch, would you like to invest in Austin or Houston? Houston's old and boring. That's how I feel. Austin is growth. It's sexy. All the folks are moving over there. It's the future. Of course, I'd rather invest in Austin, but that's based on my emotion. There was no framework, and I've actually looked at this, and I see that in Austin, home prices are growing at a faster rate. Sounds great, but I'm paying so much more to acquire that same asset. And so a lot of times you'll find when you're investing from growth, the trouble is, yes, that asset may grow in value, but oftentimes you're paying a premium up front. It's being sold for its future value, not what it's worth today. So you may not be making as much money as you'd like to. So that's why we reduce it down to math. Simplest is cash to me divided by how much it costs to buy. Another quote I want to share. Benjamin Graham. So this is Warren Buffett's professor. It's kind of one of the original academics to actually study the stock market and pioneer in the field of valuation. But he said, we must point out a troublesome paradox here, which is that the mathematical valuations have become most prevalent precisely in those areas where one might consider them least reliable. So the less reliable our projections, the more helter-skelter it becomes, the more we start to build more and more complicated models and look at more and more variables and details and alternative scenarios. And Graham reminds us, the more dependent the valuation becomes on anticipations of the future. So the more your valuation is based on what the asset will be worth in the future. And the less it is demonstrated by past performance, the more vulnerable it becomes to possible miscalculation and serious error. So, anytime an operator is presenting to an investment to you and it's based on growth, that's not a bad thing. A lot of money is made there, but a lot of money is lost there. Just take the growth that they project for you and downsize it a bit to recognize, to admit that it could be wrong. And especially when you compare that to buying an asset for its an existing cash flow, that's way more guaranteed. Nothing's guaranteed, but at least it's more predictable than the future. So you should downweight and downsize your valuations by a certain amount to take into account the fact that it's based on future projections. One more quote, and then I'll shut up. But John Burr Williams, he was also a professor similar to Graham. I don't know why he didn't get as much attention. Probably because one of his students didn't become one of the wealthiest people in the world. But he says investment value defined as the present worth of future dividends. So future dividends is just another word for cash flow, or of future coupons and principal, is of practical importance to every investor because it is the critical value above which he or she cannot go in buying or holding without added risk. So that's just, again, harping on the point that I just made, that know what the present cash flow is historically, what you think it will be going forward, and use that as a basis to make sure you're not overpaying. And that's all it's coming down to. We don't want to overpay. We want to buy things at a discount. Discount being measured as how much, what the cap rate is. The higher, the better. But that's that. Any questions? I suppose I've run over time.
Yeah, we're a little over. Let me see if I have any more. Let's see. Okay. I actually see a lot of these about the replay. Yes, there is a replay, and you'll be able to watch it instantly on Facebook, and we will get a replay uploaded to our YouTube channel. Now, if when you're watching the replay, you do have questions, you can use the contact information or you can put them in the comments. I will make sure that they get to Rosch. So if you have more questions later, that's good. Okay, let me see if it'll load me a question. Oh, and there's another one. Yes, I'm going to answer that one. We are also going to have contact information. As a matter of fact, I think I may have some of that right here.
Yes, perfect. We have a guide that we've made available. We're multifamily investors, by the way. I work for Upside Avenue, which is a crowd-funded multifamily REIT. And we've prepared a guide, purely educational, just about the different structures that folks invest through real estate. So I think that might be interesting for a lot of folks. You can email me, and I'm happy to talk about this stuff anytime. But go on, Diana. I'm sorry I interrupted.
Oh, no, not at all. That's perfect. Yes, we do have contact information. I will put it in the comments at the end, and we will also put up some additional links for more information. So do I have any more content questions? Yeah. Can I email my question directly to Rosch?
Yeah, of course.
Yep, you may get some emails there. Yes, you can. Yes, you can email your questions directly to me as well. Okay. I don't see any more. I think we lost about half of our Zoomers at the when lunchtime ended. That was a lunch and learn.
Yeah.
So, all right. Again, you have contact information for Upside Avenue. And gosh, as always, we just want to help you guys understand what it is you're doing. We want to give you options. We want to educate you, because at the end of the day, you need to invest in what you know and love. And more knowledge is always a good thing. Rosch, thank you so much for joining us today. Again, for those of you who came in late, and you know who you are, we will have the replay available on our Facebook and on our YouTube channels. I hope you all have an amazing, amazing week. Hang in there. And gosh, just as always, be well, be safe, and always remember to pay yourself first. Thank you,
Hey,
Rosh.
yeah, Diana, I just wanted to say thanks to you, and I hope we can do it again.
Absolutely. Thank you.